And again, good morning, everyone, and thank you for joining us here at the Messer Financial Weekly Life Insurance Webinar, allowing you as an agent to learn a little bit more about the products and sweet spots of the carriers that we represent, enabling you to go out and speak with your clients with additional confidence as you present their insurance needs. Again, this is Mark Contra at the Messer office just outside of Charlotte, North Carolina. A couple of basic housekeeping items for us this morning. Your phone should be muted, but just in case something might slip in, if you hear any background noise that sounds like it may be coming from your area, perhaps you might want to put your phone back on mute again. I will also ask you to stay with us until the very end. That's when we'll both review the questions that may come up during the presentation. We would ask that you would type them into that question box you'll find in the column on the right side of your screen. And then, of course, we'll review a little bit of the presentation as well as announce the bonus that would be available for any of those of you who are participating with us today. And again, today it's my pleasure to introduce to you the Sales Development Specialist with North American, a lady that I've worked with for a number of years and has been instrumental in assisting me on my personal sales, Charlene Thardelson. Good morning, Charlene.
Hi, Mark, and good morning to everybody. Thank you for having me back again. And today I've got, I don't think it's going to probably take us a whole hour. It'll probably depend on what kind of questions. But actually, I've got an idea for you of how to potentially get 3 sales out of one case on one client. And so as we kind of talk through the evolution going from one product to the next, you might see how that might fit for some of your clients. And so we will touch on some of the product details of those particular products, but by no means is this a product dump. The product details that allow this type of a transition to happen from one product to the other is what we'll be touching on. And, we call it, how to make a triple play, having 3 sales in one on one client, but it also could be a double play, so you could skip one of the moves that we talk about today in the different products. So with that, I'll go ahead and get started. And like Mark said, just go ahead and if you've got questions, we do want you to type those in, and then we'll kind of go free form on the questions here at the end. But follow along, and I do encourage you to think about your clients as I go through this, how, what clients you might have that this would work with. The agenda that I've got laid out for us today is I want to go over the concept. We're going to actually look at Adam as our case study and how his needs change as he goes through life, which is the reason for making the triple play and moving him from one product to another. And then, like I said, we'll touch on the products used in today's story so that you are just a little bit more familiar with that. And by all means, any questions you have after today, you've got a great team there at Messer Financial to go back to. So the concept that we're talking about here is how to actually end up getting 3 life insurance sales, 3 sales for which you get paid commissions on from one client. And it's the features that are built into these products. We're going to be talking about our Advantage term and our custom guarantee. Term you're probably familiar with as far as there's usually a conversion privilege in those products, and we're just the same. And so we'll spend a little time talking about that conversion and the flexibility to go to other products. But where we're gonna what's very unique for North American is our custom guarantee product, which has a conversion privilege. We call it a guaranteed exchange provision. And so that allows you to exit that product and move into another one as well. So think about it. Your client goes through underwriting one time with whatever the first product is. And like I said, this can be either a double play or a triple play, depending on how their needs change. But they only go through underwriting at the very first product. whether that's the term or the custom guarantee. And then they use one of those exit strategies, which is either the conversion or the exchange provision, to move out of that product into the next. And so it doesn't matter what's changed in their medical history. They lock in the insurability and the rate class that they had with their original policy. When they move to the new policy, they're going to take on their new attained age. So if they were in the previous policy for 5 years, well, now their new policy, they're obviously going to be 5 years older. And so why I kind of start by letting you know this is not all terms are created equal. And if you are spreadsheeting term and you're just looking for the cheapest price on term, sometimes the cheapest price, there's not a lot of difference of actual dollars and cents out of your client's pocket when we're talking about term. That's a commodity product. And so sometimes what separates the number one lowest price to maybe where we are, maybe number 5, we might be talking less than $1. And so if you're familiar with what, the possibilities are in the future for your client from having our term versus another carrier's term, having that great convertibility, then it's going to be well worth it. Your client will thank you for that in the long run. So one thing to think about term, while you might be satisfying, their initial need by keeping the cost down and getting them into a term product, really think about term as, adding to your client inventory, your client database. It's inventory to be converted later. So it's not a one and done sale. It's just the beginning. It's where you get your client started. It's where you lock in their insurability. And so, like I said, when we move from one product to the next, you're going to first get commission on the term product. The first sale, potentially the first sale, is going to be term. It could be the custom guarantee. But like I said, when you move to the second product and or the third product, each one of those is going to be commissionable to you as well. So let's go ahead and spend a little time just actually putting real people and a story to this so that you can kind of see how this would work. So we're going to use Adam throughout our presentation today, and we're going to start when Adam is pretty young and healthy. We've got him here at 30 years old. Imagine this is him and his wife and child. They're newly married, starting a family, maybe just making their first home purchase, and they do have a limited budget because obviously of the mortgage payment and probably daycare. Maybe they still got some loans they're paying off. So they do have the need for insurance, but they have a limited budget. And so by far, term is going to be the most favorable to fit into their budget. And just the fact that they've recognized or that you've helped them recognize that they need to protect that income or be able to pay off the mortgage if something would happen to one of them, so that their family could continue to live in the home if something tragic were to happen. Term insurance is a great way to get started, but it only lasts for so long. There's a very small percentage of term policies that actually pay out a death benefit because either the term has expired by the time they actually die. Because think about this: a 30-year-old getting, say, a 30-year term, it's going to end at about 60, and his life expectancy is probably about 85. So if he doesn't have something else in place, the chances that he's going to, that this term is going to pay out is really only in the event of something tragic that comes up in his younger years. But locking in that insurability and having that protection there from the beginning is what you're trying to do here. And obviously, the younger he is, the healthier he is. Look at what we're talking about here. We're talking about a super preferred non-tobacco rate class. So what you're going to see here on the next page is we're going to be able to get him that coverage that he needs for low cost. Now, the quote that I'm showing you here on the screen happens to be a 10-year term. I did mention 30-year on the previous slide because 30 is the longest that our term duration goes out. Now, if you know in your planning with him, 10 years is going to be less expensive. But then you know that you've got to make that change within 10 years and do the conversion. So as long as it's part of the strategy that you've put in place with the client, but otherwise, you might want to take the full 30-year. So what we've got here is we've got 500, let me see if I probably don't need a pointer here, but we've got a $500,000 death benefit, and it's only $15.40 a month. That's very low cost to have that $500,000 protection in place. And here we just did it on Adam, but we probably should be doing it on his wife as well. So a great way to lock in their insurability, keep the cost low so that it fits their budget, and know that you've got them protected. But make sure that when you're selling them term, because remember I had said this is inventory to be converted later. Plant the seed up front that, when things get more situated, their career is more stable, maybe a student loan is paid off, we'll come back and we'll look at, turning this into a longer solution for them, longer than 10 years, maybe for a lifetime. That, it's something, even though it doesn't grow cash value, it's still something that we need to review every couple years. Make sure that, if they've had additional children, maybe just the beneficiaries need to be updated. Or maybe they've got a new job, a bigger house, maybe it needs to be increased. So term isn't just a one and done and forget it and move on to the next client. These are still clients you need to go back to on a regular basis. So let's fast forward with Adam, and we're going to go about 7 years. Now he's 37, and we sold him a 10-year term policy, so we're getting near the end, and maybe something's changed in his health history, maybe even his own parents, because when you're the insured, your parents or your siblings' health history can impact your insurability. Like if they're diagnosed or have cancer or died, obviously some of those things can impact theirs, let alone their own. So the great thing is here is now we're at 37 for Adam, and you have gone back. You're thinking about, this is going to expire in 3 years. What should we do? He still does need that $500,000, but he does want the longer guarantee. So we're going to use the conversion. Now, North American's conversion privilege, we don't have just one product that you can convert to. Our entire product portfolio is open for conversion. The only exception is that you can't go to our survivorship, which covers 2 lives and pays on the second. So you can't, if we did have coverage on both a husband and wife, we don't allow to take 2 single life policies and go to a survivorship. But otherwise, all of the other products, so we have a GUL and we have 3 IULs. So all of those are available. What you'll find with some other companies is they might restrict you. They only have 1 product that's available for conversion. So it's important for you to know this up front when you're picking the right term for them. What kind of options are they going to have in the future? And assuming that, you might not want to go through underwriting again because you don't know what the future holds. Anything could have come up in these 7 years for Adam here. So when you go back and meet with him, he agrees with what you originally put in place, is that, now he's more secure, has better income, maybe has more children, and really needs to have a longer guarantee. So we're going to retain his super preferred rate class, and we're going to exercise the conversion, and we're going to move into our custom guarantee. This is our GUL. This is, some might refer to it as a term to 120. Technically, it's not term. It does have some cash values in the early years, but as you can see here, I'm only showing you the first 15 years. The account value never really amounts to much, and the surrender value almost always is 0. And the years beyond this, they're all going to be zeros. It's not designed to build cash value, so it works it works much more like a term policy in the fact that it doesn't have cash value. How it's not like a term policy is that it goes longer than a 10, 15, 20, 30 year duration. This actually can go all the way out to age 120. And premiums are only paid to age 100. So if the client says, well, I don't need coverage to 120, but maybe 105 or maybe just 100. Well, once the policy gets to 100, there's no more premium, so it's automatically going to be continue to have the guaranteed age 120. Now, I don't know who really maybe wants to live to 120, but we have to consider advances in medicine and that people are living longer, and so that it's not uncommon to hear of so many more people reaching age 100 and over. And so for this 37-year-old, having that protection in place, something that he really can't outlive. So what the premium changes to here for this same $500,000 when he is 37, you'll see here at the end of year one, we're listing his age at 38 because this column says at the end of year one, he will be 38. But we're looking at a premium now of $204 a month and some change. So that it was quite a premium increase from the 15 to the 204, but we've extended many years of coverage all the way to 120. Now, I did talk about once you get to 100, it automatically goes to 120. You could have a client that says, yeah, well, my family history says that, we're not going to make it to 100. So you could dial it down. We could look for a premium that goes to 99 or 95 or 90. You could do that. But I think if you compare the difference, you're going to see that it's not all that different, and why not just pay it and have it be there forever or to 120. The target on this case ends up being $2,645. So depending on your commission level, that's what you're going to have the ability to earn commissions up to based on your percentage. Now the premium that he's paying is $2,400, and the target is $2,600. But that difference of say $200, you'll still be able to earn first year commissions on that difference when they pay the premium in the second year, because we do have a 2-year rolling target. As long as at least 80% of the target premium is paid in premium by the client in year one, then we'll let it roll over to year 2. So just a great solution here. We've retained his super preferred rate class. We didn't send him through underwriting or a paramed or labs or any of that. Again, didn't have to order medical records. The transition was smooth and easy. It's going to be conversion paperwork is what you're going to have to complete. Now, when I said at the beginning that this was a triple play, which is what we're midway through here, you very well could have just started right at this point with the custom guarantee. And so maybe Adam back at 30, and of course his premium would be lower. Maybe he right then and there he saw the need to have insurance for his whole duration, all the way out to 120, and didn't want to mess with a 10, 20, or 30-year term. So you could have started right here. And likewise, when we went from the term to this product, we could also go right from the term to the next product that I'm showing you. So there's a couple different variations of, you don't always have to start with the term, but you're going to want to start with either the term or this custom guarantee. And then depending on when you meet with the client next, do you want to go just to a longer guarantee from the term, or do you want to go to a cash value? So that's where we're going to go next, is show you, as Adam starts thinking about his own retirement, as he gets more established and more secure, and just thinking, boy, my parents are in retirement now, and boy, they didn't plan very well. I need to do a better job. Or they did plan very well, and I should have been doing this, earlier. So here's when you might meet with this Adam again in his early 40s. Because again, anytime you sell a policy, you should be, if you're not meeting with him annually, because maybe it's a pretty low maintenance policy, you do still need to meet with them just to check on beneficiaries and just other things that might have changed. And again, you're still serving your client. So you meet with Adam again, and the discussion comes up, how are you planning for retirement? Did you know, maybe you ask him, or maybe he approaches you and says, hey, I got, a friend or somebody I work with or family or you tell them, hey, did you know that you could use life insurance to help save for retirement? Oh, really? Can I just pay more into that custom guarantee policy that I have? Well, no. Remember, I said that policy is not designed to build cash value. And even though you might think that you can stuff money into it, it doesn't really ever stick and it doesn't accumulate. So you would be doing yourself and your client a disservice if you advise them to put extra money into a product like that, a guaranteed UL product. Ours is definitely not designed to help that money stay in there and grow. Instead, though, let's make use of the guaranteed exchange provision, which again works like that conversion that we talked about on the term, and let him move out of a product that doesn't really allow for cash value buildup and move into an index product that can help him save for retirement. And again, we're going to be able to do this without funding him through underwriting. We're going to still save his super preferred rate class back from the age of 30. We're going to keep the same 500 because now with either of these, you could have went with a lower amount, the same amount, but if you want to go for a higher amount, then that is going to require underwriting. So think about that when you're selling that first policy. You know, look at 500 or $1 million. Try to get and lock in as much as you can that they can afford so that you have, again, the flexibility in the future. So we're going to stick with $500,000 for this guy. He's in his early 40s, looking at about 20 years to when he wants to retire. You kind of map out a plan with him of what he's maybe going to put away today, tomorrow, 5 years from now, 10 years from now, 15 years from now. You know, maybe it's a step strategy where you're going to gradually increase that. So that's what we're going to look at here on this next example. For this, we're going to use our Builder IUL. And let me get my pointer, maybe my highlighter out here. Here we are at 42. This guy still is carrying his super preferred rate class from age 30 over to this. And we're going to do $500,000 death benefit. Now, because he had said that he wanted to increase his premium over time to be able to build up more for his retirement, this amount we can't change without additional underwriting, but you can come in and state that you want an increasing death benefit option, which gives you a little bit more breathing room for the amount of premium that you're going to put in. So even though you might map out a strategy, and in this example we said, hey, he's going to start with $500 a month because he was already paying $200, and maybe he's got a retirement plan at work, but maybe it's not anything that's being matched, or maybe he's putting in up to what's being matched, and now he says, well, I was going to put an extra $300 in, but they don't match that. So now we're going to take that $300 that wasn't being matched and say his 401k. We're going to combine that with the $200 he was already paying on his custom guarantee, and we're going to start by putting $500 a month away. We're going to make some plans that, in a few years, maybe after some of the kids aren't in daycare anymore and that frees up a little more money, he's going to now increase it to $750. And then as he gets closer to retirement and the kids are off, to college, maybe making some improvements in his career and the mortgage payment, we've also got a plan here where the premiums are going to go up to $1,000 a month, and then the last 10 years, $1,500 a month. Now, those might be bigger than what your client, has plans for, but the idea is kind of map those steps out early on, so that you're designing the right product that can accommodate those premium changes. And by doing the increasing death benefit option, that does give us a little bit more room, because on that $500,000 face amount, to be able to put more premiums in without, one, violating guideline premiums, or two, causing it to become a modified endowment contract. Because the last thing that you want a life insurance policy to do, if you're going to use it for retirement income, is to become a modified endowment contract, because then it loses its tax-free advantages. So what we've got here, by moving to this policy, we've now got a target premium over $7,000. You're going to earn commissions on that. So now we're at our third product and the ability for you to earn commissions for a third time on the same client who has super preferred. We're fast forwarding here and picking up this illustration in year 21 when we're up to his higher premium of $1,500 a month on his payment strategy. And then what we did is once it, right up here, once it gets to, we're done making the premium payments in year 24, if we change it to level, that will help maximize the income amount that we're able to get out. And you can see here that at age 66, we're able to get out $54,699 as a maximum variable loan based on a 7% assumed rate from the index. Would that help somebody's retirement? Yeah, probably. Is it their only retirement? In most cases, not. In most cases, this is something that's supplementing whatever else they have in place. And so think about it that if they do have a 401k or an IRA and they happen to have had a loss that year and the market went down, that's maybe not the time for them to pull the money out. They want to give that some time to rebuild. Maybe that's where they take it from here then. Maybe Adam is going to work till he's 70. But what if he wants to retire early and have some money before his 401k is available? You know, this could be something that's planned and you design it to even just fill maybe a 5-year gap before his retirement or Social Security kicks in, if there is Social Security. You know, but so it's just important to know what you're selling up front is going to give you and your client options in the future. All right, let me go ahead and erase all my drawings there. Of course, you know, we were assuming a 7% index return, which the average based on our cap and over the last 65 years and a rolling 25 years, over 10,000 data points, our average is 7.28. So we dialed it down a little bit, but you know what? We could dial it down further. We could use a standard wash loan versus the variable. But anything, I mean, you can see here after even the first 7 years, he's taken out $382,000 compared to $315,000 he's paid in. And this continues. This income stream, when we solve for it for this illustration, we ask for it for loans from age 66 all the way to 100. So look at here. At age 77, he's gotten out twice as much as he's put in. So, you know, by all means, we can't promise that it's going to return 7%. It could be higher, it could be lower. But the possibility is there. And by having annual reviews, especially on an IUL, once that policy were in place, you know, you can watch the performance, and if you need to change index strategies, you can do that at some point in the future. All right. So just real quick, I just want to wrap up with the products that I talked about today. I gave you a lot of the information when I was talking about it, but let's go back and start with the first product we talked about, which is our Advantage Term, and it's available in the 10, 15, 20, and 30-year durations. The minimum face amount on each of these is $100,000, and the conversion privilege pretty much is wide open for the whole duration, the 10, 20, 30 years, or an age requirement. So the 10, 15, and 20 year, you can do the conversion through age 74 if they happen to be older clients, or on the 30 year, they can do it through age 69. But in the example that we talked about today on a young person like that, you'll really just have the full duration to make that change. But don't let it pass by. I mean, I don't really know that we as a company ever even send out something that says, hey, your term policy is coming to an end. Do you want to do the conversion? It's usually is what happens is they get their new premium notice that says instead of $15 a month, now it's $300 a month. And then the next year it goes up, you know, I mean, and sometimes those are even more, especially on a 30-year duration, those premium increases are going to shock them when they see it. So make sure that you set a trigger or a reminder to meet with your clients before their conversion period expires. And it's right in the policy when you deliver it. Make sure you highlight that. Make sure that if you're not around to help them, that they remember that, or that that if they're looking at their policy, they're drawn to that and can not let that go by unnoticed. The custom guarantee was the second product that we talked about. That was, I said there's no premiums beyond age 100. It's guaranteed death benefit up to 100. Once you get to 100, it automatically goes to 120. But I also talked about how we could dial that down to different ages. And it has that guaranteed exchange provision. That was that conversion type exit strategy that we used to get into the IUL cash value product. And then the last product that we touched on was the IUL. Now, we had 3 different IUL products, and one of them happens to be a guaranteed product where you also can have cash. So that one is not available coming from the custom guarantee because they both are guaranteed death benefit products. So the focus or the options coming out of the custom guarantee would either be to the builder or the rapid builder. And because of his age and his rate class, the builder by far is the best, and it has the highest target for you, and it has the best cash value accumulation possibilities for the client. So variable interest rate loans, that's part of what's happening behind the scenes in the illustration that I showed you. When they take that loan, and let me just back up for a second. Let's go back to that illustration. One more. Here we go. When they take this $54,000 out as a loan, you can see over here they had 5. This is the end of the year value, but they had between $550 and $590 of cash value. So they take this loan out, and we let that loan amount still stay as part of the account value. You can see that it went from $550 to $590 to $630, and you're like, wait, why is this number going up if they're taking money out? Well, it's a loan. So it's still a part of the account value, but it's not a part of the surrender value. So if they were to walk away, well, then we have to pay off the loan, and then we'll give them what's left. But a variable loan, what happens there is we let this $54,000 stay as part of the account value. So all of this account value, whatever index selections are in, it gets to participate in that. And so in this example, we're showing that the index is returning 7. And then on this illustration, I think we probably ran it at our max, our cap rate on our loan of 6%. So our loan rate will never be higher than 6. And so even though you're paying 6% on the 54, you're earning 7% on it as part of the account value. So if you're earning 7 and you're paying 6, you're still coming out with net 1% positive arbitrage. So positive interest that you're earning on money you took out. And that continues during the life of the policy. Now, granted, the index could be down if we're at the cap rate of 6% and the index only returned 5 that year. Well, then you are paying an extra 1% on that. And at that point, maybe you decide that you'd rather switch to our net zero cost loan, where we take the money out of the index account, move it to the fixed account, where we credit 3 and we charge 3. So if we're crediting 3 and charging 3, the net result to the client is 0%. So we do have those 2 different loan types. The client can switch from one loan type to the next, but they only can ever have one loan type out at a time. I think I went one screen too many. So talks about the variable interest rate loan. There's overloan protection and a protected death benefit features embedded in the policy that can be exercised in the future. Basically, those are just safety nets that as you start taking a loan, that the loan, if a policy lapsed with a large loan on it, like after you've taken $600,000 out and you've only paid $300,000 in, if it lapsed at that point, that's a $300,000 taxable event. It's these 2 features that can help prevent that from happening. And Unless there's a question on that, I'm probably not going to dive deeper into that during this presentation, but that's obviously a question that if you're interested in knowing more, please type that in and we'll address that at the end. Or you can reach out to the Messer team and they can explain that more to you in detail. We do have 13 different index selections that the client can choose from to diversify their funds into. As long as they equal up to 100%, however they diversify, 25 here, 50 there, 10, whatever, they can do that. And they can change them with each ongoing payment or have them reallocated upon their one-year renewal. There's an interest rate bonus of 75 basis points that's guaranteed. We guarantee an extra 75 basis points on the index account, whatever it's credited, above the floor and above the cap, and that begins in year 11 and on. It's guaranteed. It's not conditional, it's guaranteed. And the illustration I shared with you today also did take that into consideration. So when we were showing 7%, it actually turned into 7.75 out at years 11 and on. And there's a footnote on the illustration to explain that. We do have a fixed account, but we don't require any money to go to that. And so if the client chooses to allocate money to the fixed account, that's fine, and they can move it out of there at any time. But money that goes into an index account has to stay there for a one-year period because that's the index segment. Daily index sweeps just means that the day that we receive the client's premium is the day that we'll move those funds into the index allocation of their choice. Some companies only sweep it once a month, say on the 15th, and if we got the premium on the 16th, then it has to sit in the fixed account until the 15th of the next month. So important to know how the index works for your clients. Both the builder that we talked about today, the cash value one that I just went over, and then the one just before it, the custom guarantee, have an accelerated death benefit endorsement that includes all three of these: terminal, chronic, and critical. The term only has terminal illness, where they can accelerate if they become terminally ill. Our terminal illness definition is that if the doctor certifies that they have a 24-month life expectancy or less. With some other companies, you might find that to be shorter, like 18 or 12. So it gives them a smaller, shorter period of time at which they can accelerate and get those death benefits. Chronic illness is if they, and these are all included at no cost upfront in the policy, as long as they meet the age and rate class requirements. And in the scenarios we were talking about today, it's no problem. So it's more like when you get to 75 or 80 that some of these might not be included or above those ages or table ratings. And for those details, again, we'll dig into those if somebody needs that. But chronic illness is a way to accelerate your death benefit if you become chronically ill, can't perform at least 2 of the 6 activities of daily living. It has to be considered a permanent chronic illness, not just temporary while you're recovering from a hip surgery, for example. But in the case like either, well, that middle product we looked at, the custom guarantee, where there was no cash value, you know, that poor client, if they become chronically ill, there's no money for them to take a loan against. And if they're chronically ill, wouldn't it be nice if they could get their hands on their death benefit maybe while they're living to help? You know, so life insurance isn't all about the death benefit. There's more of an emphasis now on some of the living benefits that you can get from IUL, or from life insurance, I should say. And so chronic illness, for that client that was all zeros for cash value, this is a way that they can accelerate that and get that. Again, there's no fee for it up front to have it, but if they exercise it, then there's a discount that's taken, and there's a maximum and a minimum that they can accelerate. But then we'll take a little piece of it at that time that they accelerate it. So they're only paying for it if they use it. If they never use it and they die of some other reason and never become chronically ill, then it hasn't cost them anything. Critical illness, again, that's included. That's a way to get your hands again on some money while you're still living if you have a chronic event. And those are things like heart attack, cancer, stroke, that you can accelerate that. And again, you only pay for it if you need it. and it's a flat discounting, but it's a way, again, to get to cash. For the chronic and critical, if you're in that last product, that builder IUL where you have cash, because you're going to pay for it when you use it to get to your death benefit, if you have enough cash to help you out with your need, it might be more beneficial to do that. But that's something, again, choices, options for your client. All right, so that's what I had to cover for you today. Let me just wrap it up here. We talked about the concept, how we've got multiple solutions to meet your clients' changing needs over the years. It's up to you to set them up with a product that's going to help them get there. It's up to you to meet with them and discover and learn if now is the time to make a change or a transition. I took you through Adam's story to show what one might look like, and how it might change over time. And then I just, wrapped it up with some details on the products that we had used in today's example. Again, it doesn't have to be an all three-step process. I talked about how you could start at term and go straight to the builder IUL, or maybe the guarantee builder, or you could start right at the middle one, custom guarantee, and then go to an IUL later. So there's a couple of variations that you could take there too. The bottom line, what does your client get? Well, they get that death benefit protection right from the get-go. They lock in their insurability. They get the death benefit protection for that mortgage, their young family, and then a low premium to start with, and then we moved them to a higher premium, and then we gave them that great flexibility on the final product when he's trying to build it for his retirement. So a lot of moving parts, but to meet their ever-changing needs. What do you get? Well, you get a commission opportunity on each one of those, and then a lifelong client. So, this is a client that you're going to keep going back to. Remember, I talked about term. It's inventory to be converted later. It's not just sell term and well, those people are taken care of for 30 years. It's not that. It's the first step in the product that's going to meet their needs for a lifetime. So what I hope that you'll do as a result of today's session is that I hope you identify more than 3, but start with at least 3. Think about 3 clients. Maybe it's your clients, kids who are getting married, depending on what your client database is. Hey, John, I know that your son just got married and bought a house. Have you talked to them about life insurance? Could you give me a warm referral to them? So make a call out either to get that referral or to the client themselves, and position North American's products as a way to get them started and to give them the options down the road. And with that, I'm going to turn it back to Mark, and we'll see what kind of questions we have and closing comments.
Well, again, thank you very much, Charlene, for another impressive presentation. Always enjoy working with you because you always bring the agent back to the real world and asking them to go back out there, identify the clients that they could use this with so that they'll actually put into work, hopefully today, the lesson that they've learned.
Absolutely. Absolutely.
Okay, guys. If nothing else, I hope the very first thing that happened was you heard the message that that life client that you established today should not be just a one-time client. I hope that really lit up in your thoughts and you now recognize the importance for having those policy reviews. Well pointed out by Charlene, you don't have to do a policy review every year. Obviously, if you're in communication with your client and there's been some life changes, maybe a baby, maybe they've had an inheritance, perhaps there would be a better need in that first year. But again, within that 2-3 year period of time, if you have done the job to begin with, and that is if you've planted that seed, they're going to remember when you call them back and you say, hey, remember when we talked 3 years ago and we were starting off with a plan that you needed immediate coverage for, but I also asked you to keep open to the opportunity in the future that we may be able to enhance those benefits as your needs change. So you as an agent really control the circumstance, and you actually control your own income potential out of the life business. I think oftentimes, too, it goes, and that is said by any of the presenters, wisely presented today by Charlene, that you be aware of what the target premium is, because the target premium is truly what represents your commission. And as you look at illustrations in the future, you're going to find a place on that illustration. Sometimes it will say target at the very bottom. Sometimes it'll just say TP, and there'll be a number, no dollar signs, just a number. But that's what wakens you up as an agent. And obviously, if it cannot be all consumed in the very first year, that means it's going to have a trail. That means you're going to have an income opportunity as those premiums come in the 13th, 14th, 15th month of that new product policy. So keep that all in mind. Most importantly, obviously, to take advantage of any of this and all the benefits that are going to be available to you from North American, we would certainly ask that you visit the Messer website, drop over to our agent resources file, go on to our online contracting, and get your contract started for North American. Again, Charlene has done a wonderful job with us on a number of occasions already this year, and we've already lined her up again for later on to again bring to your attention those things that you as an agent need to learn. Also, though, it's important to know that once you are contracted with North American, you're going to also receive from them, I will say quite frequently, an email letting you know that they're doing a training, just an online. So if you're really aggressively trying to learn more and more about the business, that door is going to be open to you, not only attending our weekly opportunities, but to see all the things that they're going to present to you and the other opportunities that you'll have. As Charlene said, please don't hesitate when you have questions to give us a call at Messer. But you're also going to find that once you've opened up that door, once you've got that appointment, a very friendly team at North American that will be there to help you. It's possible you in the house with a client at 6 o'clock at night. You've got some questions on a product, and you can't reach anybody here at our office. So again, you need a couple of places to go and always have that opportunity to get a better understanding quickly. As far as the questions, again, this morning we don't really have anyone. The only question we had was something I missed, and thank you very much, Holland, for bringing that up. This presentation has been recorded, and Rebecca will put it up on the Messer website within the next 48 hours. Again, by going over to the Agent Resources tab, dropping down to what's called the Messer Learning Center, you'll find under the new presentation window the modules that have been put up on our system within the last basic 6 to 8 weeks. So thank you for bringing that up, Holland. Last but not least, and it's always important to know, again, we do value our relationship with you. We do value your business. We would like to see you bring in a piece of new business with a North American tag on it within the next 30 days. If you will do that, we will enhance your commission here from the Messer opportunities by $100. So not only earn the normal commission, but pick up a little extra. Again, we ask that you bring in that new application to us or directly back into North American, which, by the way, when you're using our quoting tool, you're going to find the easy online electronic application process available, and then have that policy issue basically within a 60-day period from the point of entry. So that's not unrealistic with your first cases that may have some underwriting responsibilities. So we're going to give you enough time to get an app in and get an app out and a policy issued, get paid your commission, and get paid a little bonus. Charlene, all I can say once again is thank you very much for the education, for the time you spent with us, and for opening up some new thoughts and ideas.
Absolutely. Thank you for having me, and I hope everybody has a great day, and I'll catch up with you again when I come back to present whatever that next date was we scheduled yesterday, Mark.
That's somewhere in October, I believe.
All right. Awesome. All
And
right.
also,
Thanks again.
yes, ladies and gentlemen, please also realize that our expo is coming up here in September. We're running up on that pretty close. So make sure that if you're not registered, if you're in the area and you want to participate, we'd love to have you. Get to see a lot of our carriers face to face as they participate there with you. Get to know them so that they know you when you call in. Pick up some good knowledge. Rub elbows with some other successful agents. And most importantly, have a good time. So again, Mark Hunter signing off until next week. Let's go out there and find ourselves some new opportunities.